We've got with us Sonal Verma, India economist at Nomura Financial Advisory and Securities, joining in on the show. Sonal, thanks very much for taking time out and being with us. Now, $30 billion is what the ET Now poll is suggesting. Now, given that the finance minister has repeatedly shown a lot of concerns over the widening CAD, he's also taken measures, like raising the gold import duty to raise in the ever-increasing crevice. Do you think that we could see a number such as this?
I think $30 billion or so in the December quarter is very well known by now, and our forecast is also around the same number, which roughly translates into 6 to 6.5% of GDP. Now, what happened in the December quarter was, I guess, of course, we had Diwali-related increase in gold imports, but also anticipation that there would be some customs duty on imports, on gold imports, I think led to sort of a preponement in gold imports. So gold imports actually picked up quite substantially in that quarter, which is why, we are likely to see such a high current account number this quarter.
You think that would change in Q4, or does it remain elevated even in Q4, possibly even the next 2 quarters of the next fisc?
No, we should see an improvement in the fourth quarter, which is the Jan-March quarter. We've already got the Feb trade deficit number, which has narrowed from $20 billion in Jan to almost $14.9 billion. And all indications are that even the March trade deficit number will be lower. So our expectation is that the CAD numbers, which will be in the 6 to 6.5% of GDP in the third quarter, should moderate to 4 to 4.5% of GDP in the fourth quarter. But I think, before we start celebrating, the fact is that seasonally, the trade balance actually tends to improve in the March quarter. So I think part of this improvement is because of the seasonal factors, and partly is because we're seeing sort of a payback from the preponement we had seen on gold imports. So the question is not whether the CAD will improve in the fourth quarter, but whether it will sustain beyond that. And there we still actually have some concerns.
So now, what do you think are the other short-term measures that the government could take to help finance the current account deficit?
Well, I think we are already doing all the short-term, quick fixes as far as tackling the external sector pressures are concerned. We've opened up limits on FIs, both in government security and in corporate bonds. We've increased the import duty on gold. Oil prices are also being hiked, which is not a short-term fix, which is a long-term fix. But I think at this stage, we need to have some long-term solution also in mind. And if you look at the details of the current account, one trend that we've seen since 2007 is that in a lot of sectors, what we are seeing is sort of reverse import substitution. So we are basically importing a lot of manufactured products instead of producing them domestically. This is seen in cases of textiles, electronics, toys, etc. Many products. But essentially, unless we tackle this, unless we tackle the fact that the commodity intensity of India's import basket is only growing, the quick fixes in the short term will not really help us in the medium term.
Just before we talk about other things, just wondering, there was a lot of talk being made around this rationalizing the FI debt limits. Is it a really big measure, or you don't believe it will have a significant impact?
Well, our view is at the margin, obviously, it is a positive development. There were also expectations of some rationalization on the withholding tax front. But in any case, easing up the procedure in itself should be a positive at the margin, though, because there are still, limits which are unutilized.
Right, and Sonal, just taking off from a comment that was made by Subir Gokaran, the former RBI Deputy Governor who we chatted with this morning, and he said that, there is a need to address the food inflation on high priority. Given that it's been persistently high, what are the structural measures you think the government needs to take to deal with this?
Well, I think, there are many things, but what I'd, highlight is, obviously on the productivity side, we've not seen any improvements on agriculture productivity, whether it's raising investment in terms of irrigation, better seed quality. Those are the long-term supply side issues that the government has to focus on. But I think also very importantly, the minimum support price, what we've seen since 2007 FY13 is that on a compounded annual average basis, MSPs of different food grains have moved up by almost 20% year over year. Now, when you raise MSPs by 15-20% every year, you're basically raising the floor prices for food. And then we've linked, MSP prices are dependent on CPI inflation. CPI inflation is dependent on food. Rural wages are tied up to CPI inflation. So we've sort of created this spiral between food, CPI, MSPs, wages, etc. So I think one of the things we need to do, apart from focusing on boosting productivity in agriculture, is basically, to raise MSPs only as much as is required, because otherwise we're creating a spiral on food inflation.
Right. Sonal, I want your opinion on one more thing. We've got source-based information, of course, but from the FinMin about how the direct tax revenues are likely to see a shortfall of almost 30,000 odd crores for the current fisc. And now, this is one more piece of bad news that is coming in when it's expected that CAD would be weak as well. What are the implications on the fisc deficit target?
Well, it doesn't have much implication really, because when the government presented the budget, in Feb, the slippage on the tax revenue front was very well known. In fact, as a result of that, spending has been curtailed, and even in February, government spending is up only 3%. So government has basically made up for the loss on tax revenue by cutting down spending. So as far as the fiscal deficit target is concerned, which was 5.2% revised estimate for FY13, I don't think there should be any impact at all, because spending is also being curtailed.
Okay, so then the follow-up would be, Sonal, do you think 4.8 would be a realistic one as well? It's a long-drawn target, of course. Lots of things happened before that, but the sense that we got when the budget came out was that the revenue targets were optimistic, the expenditure targets were not that realistic as well. Is that a view that you have too?
Well, our view is, surely the revenue targets are optimistic, because we are not as positive on the growth outlook. I think the budget is assuming around 6.5% real GDP growth in FY14. Our expectation is it's going to be around 5.6%. Some of the leading indicators that we track, and we have a lead of about 6 months, we do not actually see any recovery over the next 6 months. So even if there is a pickup in the second half of the year, we don't think it's going to be, as high as 6.5%. So revenue disappointment will be there. There is an expectation that even if there is a revenue disappointment, the government will cut down spending as it did in FY13. But I think, fiscal 14 is very different from FY13. This is a pre-election year, and our view is that there is going to be a pickup in government spending closer to August, September, closer to the election. So 4.8% target does seem a bit optimistic to us. We are at 5.2 for FY14 as well.
Sonal, it's been great chatting with you. Thanks very much for taking the time out and giving us your assessment on the current account deficit as well as the overall economic situation.